Hello, everyone. Welcome to the News Browse News broadcast. According to a report by Sanctions, rising tensions in the Middle East have triggered a sell-off on Wall Street, driven by investor concerns that potential conflict between the United States and Iran could continue to fuel inflation. Both oil prices and U.S. Treasury yields climbed. As a result, major Wall Street stock indices retreated from historical highs on Wednesday, June 3rd, ending a 9-day winning streak. Among the major indices, the Dow Jones Industrial Average dropped 620.72 points or 1.21% to close at 50,687.07. The S&P 500 index fell 56.1722 Cusbriting Mind Tatey Thread 270 Plast 500 index fell 516 points or 0.74% to 7,500 point high ready taken 90.72030.98 own sub shucks 4. Kanda Riddiai 7D 9000 Sident paring 16 9007s. In individual stock action, TSMC's ADR experienced a significant decline, tumbling $10 Airy sought or 2.24% to settle at $436.69 IST. According to Itele News NNN, U.S. President Donald Trump claimed on June 3 during a podcast program that Iran has agreed not to possess nuclear weapons under negotiations to end their conflict. Trump also expressed his belief that Iran's supreme leader, Ayatollah Mojtaba Khamenei, is definitely involved in the decision-making process for these talks. Trump conveyed his willingness to hold a summit, stating that depending on the situation, they would eventually meet. However, the actual situation on the ground remains highly volatile as military clashes between the United States and Iran continue to intensify. Iranian forces launched a ballistic missile attack on Kuwait International Airport, killing 1 person and injuring over 60. In response, the U.S. Central Command announced defensive strikes on an Iranian military control facility on Qasem Island in the Strait of Hormuz. Additionally, the U.S. military targeted an oil tanker heading toward Iran's Karg Island for violating a maritime blockade. These ongoing exchanges of strikes have left the future of the ceasefire negotiations highly unpredictable. According to a report by the Epoch Times, Japanese regional banks are accelerating their withdrawal from China and shifting their overseas expansion focused toward emerging markets in Southeast Asia and India. This trend is driven by rising labor costs in China, deteriorating business environments for Japanese manufacturers, and global supply chain restructuring. Data reveals that the number of Chinese branches, offices, and subsidiaries of 61 Japanese regional banks dropped by 20% between 2021 and 2026. Major institutions like Hokkaido Bank and Bank of Kyoto have recently closed or integrated their Chinese offices due to dwindling customer demand, especially from Japanese automakers facing stiff local competition. Simultaneously, credit exposure of Japan's 3 megabanks in China has fallen significantly. Conversely, these financial institutions are ramping up investments in Southeast Asia, with Singapore acting as a primary regional hub. Additionally, India, with its massive population and growing high-tech industries, is emerging as a critical strategic market, prompting banks like UFG and Kyoto Financial Group to establish strong footholds there. According to GG Press, the U.S. Federal Reserve Board released its latest Beige Book economic report on June 3rd, indicating that economic activity expanded at a slight to moderate pace in 10 of its 12 districts. This represents an increase from the 8 districts reporting growth in the previous April report, suggesting that the overall assessment of the U.S. economy remains steady. However, the report highlighted that rising uncertainty and early signs of a slowdown in consumer spending are weighing heavily on business sentiment. In particular, the ongoing conflict between Israel and Iran has driven up energy prices, casting a shadow over business activities. Most districts reported price increases, with higher energy costs pushing up the prices of food, fertilizer, and transportation. In several districts, businesses have temporarily absorbed these rising costs rather than passing them on to consumers, leading to growing concerns that corporate profit margins will be squeezed. According to a report by the Epoch Times, the United States government has announced sanctions against 2 commanders of armed groups operating in the Eastern Democratic Republic of the Congo, DRC. The individuals targeted are Gustave Kubwayo, a commander of the Democratic Forces for the Liberation of Rwanda, FDLR, and John Imani Nzenzi, the intelligence chief of the M23 rebel group. The U.S. Treasury Department accused both leaders of inciting violence, destabilizing the region, and exacerbating a severe humanitarian crisis. Under the sanctions, all U.S.-based assets of the commanders are frozen, and U.S. citizens and entities are prohibited from conducting transactions with them. U.S. Treasury Secretary Scott Bessent emphasized that the action reflects the administration's commitment to ending the decades-long conflict in the DRC. The U.S. government also urged the DRC and Rwandan governments to uphold their commitments under the Washington-mediated peace agreement signed in December 2025. Specifically, the U.S. called on the DRC to eliminate threats from FDLR forces and demanded that Rwanda withdraw its military personnel from the region and halt all support for M23. That's all for this video. Thank you for watching. See you in the next video.